Hey guys, this is Chris from Globalization Guide, and in this video I want to explain to you the concept of CFC rules, controlled foreign company rules or controlled foreign corporation rules. So what are CFC rules and what is their purpose? CFC rules are generally in place to prevent the use of shell companies through citizens or by citizens of high tax jurisdictions or by residents of high tax jurisdictions. We live in a world where there are countries with very high corporate taxes. Generally, this is the Western world, the European Union, the United States, Canada, Australia, New Zealand. And then there are other countries, other jurisdictions that have very low or in some cases even no corporate taxes, at least on some income forms. And without CFC rules, nothing would prevent a citizen from one of those high tax jurisdictions to use a legal structure of a low tax jurisdiction to run his complete business. And then all of the money he makes is basically tax-free or at least taxed at a much lower corporate tax rate. CFC rules prevent this. When you, for example, are a citizen of Germany, here, you live in Germany, you're a German citizen, you're a resident, you can't just open a company, let's say in Panama, where there are much lower corporate taxes and foreign income that a Panamanian company makes is taxed at 0%. With CFC rules, they will not allow you to live in Germany and operate or even own a significant share of this Panamanian company. They will allow it technically, but fiscally, from a tax standpoint, the German tax authorities treat that foreign company the same way they would treat a German company. But even worse, there are a bunch of penalties and downsides that you inflict on yourself if you want to operate a company like that. So it becomes fairly useless for most people. Now, there are different classifications of CFC rules, and they are basically, they differentiate themselves by how strict they are and if they're targeting actively managed companies or as well as passively managed companies. Generally, it's more common for CFC rules, much more common to target passively managed companies, because this means there is no really an active business. This means you open a company in a country and you move passive assets to the company. It could be dividends, could be earnings through interest, through these income streams that don't require really an active management of a business. And then when it comes to the rules regarding actively managed companies, now we're looking at the percentage that you own. We're looking at, does this company have any economic substance in the country it's operating in, or it's founded in? Does it have employees? Is there an office? Does it have any assets, and so on? And all of this then comes back to these CFC rules, and they will determine if that company is compliant or if it's going to be affected by these rules. Below this video, I've included a link to the article where you can see a list of important countries, what their CFC rules are, a broad generalization, categorization, and then also where you can find more in-depth information for a specific country, where you can read up about the specific CFC rules of those individual countries. That's it for now. If you like this video, please hit the like button. Subscribe to my channel if you want more information like this, and I'll see you in the next video very soon.